After price appreciation, you are worth, say, 100 million. How would you borrow, say, 20 million and not lose your assets? And how does it get paid back? There's a couple different ways that you could structure this. If you're worth $100 million, PPLI is definitely a vehicle that you probably would want to know about. And you would want to structure a policy that you could be able to borrow against. Now, it takes some time. Most of those need to be a 5 pay or a 10 pay, which means you pay that over a period of time. Then you're able to, borrow against the cash value in that policy as the assets appreciate. You could borrow against those assets inside the LLC and draw down a line of credit against them. And then as they appreciate, you just refinance the loan with the same assets. And you might buy an annuity that would make the interest payments for you so that you don't have to worry about that. And you could live off the rest or use it to fund your lifestyle or buy a business, do whatever you wanted to with the money because it's tax free since debt is not income. You do need to show the debt though. So again, it's interest only on most of these notes with the balloon payment at the end for the total. So hopefully, maybe you're going to buy an asset with it that doubles in value over 12 months or over the term of the note. And then you're able to sell that investment, recoup your original and have another 20 million and then pay off the original note. And you've still got the asset or a portion of the asset or the company. That'd be a great way to do that. Or you buy public stock that's going to double over a 3 to 5 year period, and then you're able to borrow against that and be able to pay off the original note on the other side, maybe at a lower interest rate. That is how wealthy people grow their portfolio. They buy, borrow, die. And most of the time they use the insurance vehicle and some reinsurance to be able to pay off the debt. So if you got it inside of an insurance policy and you borrowed against that and you got the cash value, or even if you had it on another note, you could make the lender the beneficiary of an insurance policy for the total amount that you owed them and just pay the premiums into that policy so that they didn't have to liquidate your assets when you die to be able to pay off the loan. It'll go to your beneficiary. It'll go back to your estate, and then they would get the life insurance policy to cover it. So there's a lot of different ways that you can structure it to make sure that it gets paid off at the end of your life and the assets aren't liquidated.